Mutual funds are pitched as being perfect for retirement planning, but the reality is that mutual fund fees can make the funds a lot richer and the investors a lot poorer. The math is pretty shocking. Say the fund returns 4%. Subtract 2.53%, the average fee charged by Canadian mutual funds, and you're left with a return of just 1.47%. But factor in inflation, which was 1.6% at the start of this year, and you're left with a loss, minus 1.3%. Mutual funds manage $1.2 trillion of Canadian savings. So at 2.5%, that's $30 billion in fees. No wonder the sales force is so aggressive. By the way, AFBS charges less than 0.5% to actively manage members' money, more than 2 full points below retail mutual fund charges. Jonathan Chevreau is a columnist who writes books on personal finance. What do mutual fund fees do to an investor's return?
Well, over 30 or 40 years, an investment horizon for if anybody wants to retire, they can degrade your performance by 30 to 40%, depending on the fee.
Around the world, half of the countries, 17 countries that were surveyed, had mutual fund fees of about 1.3% for equities. What was it in Canada? 2.6%, exactly double the global fees. We're notorious for having very high fees, and as I said, not great performance. So low performance, high profitability. You need to know what you're paying for the money you're investing.
On top of fees when you buy, you often pay when you sell. It's called a back-end load. We looked at one fund, AGF's Clean Environment Fund. The fine print tells you that if you sell in less than 2 years, you pay 5%. It drops a percentage point a year until after 6 years, there is no penalty. The mutual fund industry promises to make all these numbers clear by the end of the year. But the average investor would have a hard time sifting through all the numbers to find the expenses. Armin Yalnizyan of the Canadian Centre for Policy Alternatives is an economist, and even she finds it all confusing.
You know, the reality is that even when I ask my own financial advisor for the fees that I'm paying, the answer turns out pretty unclear. The post-inflation return of most investments in a world that is a slow growth economy, that's the key here. Nothing is growing all that much, and even when inflation is low, it can leave you paying the fund to be able to invest your money.
Only the super rich get their money managed for less than 1%. Without mentioning names, we asked Jonathan Chevreau about a theoretical fund charging less than 1%. What about an actively managed fund that charges well under 1%?
Well, that's the best of both worlds. I mean, there you're getting a reasonable fee, and you're getting actively managed funds, which allows you not to worry about so much about individual stock performance and market performance. You can find that, that's good, but if you don't, you're going to be in the hands of some young salesperson who probably has their own retirement at heart ahead of yours. And if you end up in those funds of 2.5% to 3%, you definitely want to get out of them.
Here's an example of what fees can do. Take $5,000 invested over 40 years. Because the commercial fund is charging about 2% more than actor fraternal, the final return will be $113,000 for the mutual fund and $235,000 for AFBS. Quite a difference, $122,000 or 52%. This is Fred Langan reporting.